Today, we are going to be talking about two very popular stocks right now. The first is Nebius, ticker symbol NBIS, and the second company is DLO, ticker symbol DLO. One of these two companies has a very interesting backstory that we're going to get into, and we're also going to dive into their financials. And I'm going to give my opinion on where I think these stocks are headed and whether I would look to invest in these two companies. And let's start with Nebius. Nebius actually went public back in October of 2024. We'll dive a little bit deeper into this here in a second because that isn't the full story. But since April of this year, the stock is up over 160%. The stock dropped down to lows of around $20 per share during that time period where the trade war was at its peak. But again, from then till now, we have seen a massive move up in the stock price, and it's now trading at over $50 per share. So what exactly does Nebius do as a business? Like a lot of other popular companies in the market right now, Nebius is an AI cloud-based infrastructure business. Basically, what that means is they allow other companies to use their GPUs in their data centers to build their AI models. However, this company has not always been known as Nebius. They were formerly known as Yandex. Yandex was a parent company that held a number of different businesses, one of those being a Russian technology company also known as Yandex. However, when the conflict broke out between Russia and Ukraine, a number of different sanctions came into play that forced the selling off of Yandex and the formation of Nebius. So with this company just forming in the last year, they've started to put up some year-over-year numbers. In Q1 of 2024, they put up around $11 million of revenue. In Q1 of 2025, they put up $55.3 million of revenue, almost a 400% increase year over year. With revenue increasing by almost 400%, it's clear that Nebius is a fast-growing company. However, with it being in the AI infrastructure space, it needs to constantly reinvest in its business. And they are doing just that. They brought on data centers in Iceland, Kansas City, as well as New Jersey. And probably one of the biggest worries with a business like this is how quickly they can scale based off the amount of cash that the company actually holds. Nebius a year ago had around $2.5 billion of cash. However, this year, that has dropped down to around $1.5 billion of cash. So in just the last year, they have spent $1 billion building out their business and continuing to build their infrastructure. And we can see that around half of that cash went towards property and equipment, because a year ago they had $850 million of these assets. However, in their most recent quarter, that increased to around $1.3 billion of assets. I think the big question for Nebius is, will they have to start loading up on debt to continue building out this infrastructure? In terms of their operating expenses, they all seem to be trending in the right direction, at least as a percent of revenue. We are seeing massive increases in these expenses. However, as a percent of revenue, they are decreasing year over year across the board, which is a positive sign. However, I don't think this company is close enough to getting to profitability to really start investing those profits back into the business, which likely means that they will have to take out some debt in the short term to start reaching profitability and building out to a larger scale. And you can really start to see this when you look at the guidance that Nebius provided for 2025. They're projecting that revenue will come in around $500 to $700 million. However, their capital expenditures, they're expecting to spend around $2 billion of additional infrastructure to continue to build out their data centers. That means that Nebius could be spending almost 4 times their revenue on capital expenditures, and right now the company is trading at 25 times revenue. So these are kind of expensive metrics for a business like Nebius that really is going to have to spend a lot of money in terms of CapEx to continue growing the business as quickly as we've seen. So for me personally, it's a little bit too early to actually invest into Nebius. I want to see how the business performs over the next couple of years and what their focus is on, because they could focus on their bottom line. However, that is going to prevent them from scaling. If they want to scale, they are likely going to have to take out a large amount of debt to continue to build out their infrastructure. We might get some insight to how the company is actually going to approach these things here on July 29th when they are set to announce their next earnings. But let's jump into DLO. DLO went public back in 2021, which was a great time for a company to go public if they wanted to maximize their IPO. However, from the highs that they reached in September of 2021 of almost $70 per share, since that time period, the stock has fallen by almost 85% to a current share price of just under $11. DLO is another international based company currently headquartered in Uruguay, and what they primarily do is they are a payment platform that helps businesses sell their products internationally, especially in emerging markets, and they help kind of broker that transaction between different currencies. And overall, this is a very fast growing market. The rest of the world tends to lag behind the United States, so this payment kind of processing network that has been built out in the US for really the past 5, even 10 years is really just starting to hit international markets. We can see this through their total payment volume. That's a very common metric for businesses like this. You look at PayPal, they focus a lot on their total payment volume. It came in at $8.1 billion, which was up 53% year over year compared to a year ago when they had $5.3 billion. In terms of the revenue that DLO actually brings in from these payments, they brought in $216.8 million in their most recent quarter. That is up 18% year over year. However, that doesn't tell the full story. On a constant currency basis, this would actually be up 36% year over year. So that is very important to keep in mind and could be a similar trend for DLO over the years to come because they have so much international business. And even though this company is growing quickly, they are still able to bring in positive net income. In the first quarter of 2025, they brought in $46.7 million of net income, or around 15 cents of diluted EPS per share. That's up around 163% year over year, or up from 6 cents per share a year ago. And honestly, this company's profitability could start compounding on itself because their margins are continuing to expand. Gross profit margin increased from 34% a year ago to 39% in their most recent quarter. And their profit margin increased from 10% a year ago to 22% currently. That is a massive increase year over year and should only help their bottom line numbers. On August 13th, they're expected to announce their Q2 earnings. So we will get to see if this trend continues and if the company can kind of keep up this rate of increasing their revenue at a very fast pace, as well as expanding their profit margins and increasing profitability of their bottom line numbers. And if the company is able to do this, you can easily make the argument that they are currently undervalued because their forward P ratio is only sitting at a 19.38. And right now, analysts are anticipating around 19% growth in EPS in 2025 from 51 cents to 61 cents for this year. And then in 2026, they're expecting growth to accelerate even further to around 23% EPS growth to 75 cents of EPS in 2026. So for a company right now trading at a 19 PE ratio, that puts their PEG ratio over the next couple of years at below or around a 1, which is a fair or even low valuation for a company that is experiencing almost 40% top line growth. But do keep in mind that international companies tend to trade at lower valuations compared to their US counterparts. So that could be a factor to make sure you keep in mind, because if you are running valuation calculations on a company like DLO or even Nebius, oftentimes you need to consider that international aspect and kind of drop your valuation metrics slightly to account for it. In my opinion, out of these two companies, I actually think that DLO is potentially the better buy. If I had to buy one of them, I would likely buy DLO over Nebius. Nebius has seen a massive run up. I think they have a lot of execution risk with how much they are going to have to invest into their business. DLO, I think, has a lot of metrics trending in the right direction, and their valuation is relatively low, as well as the stock has underperformed over the last few years. So I think they have a lot more opportunity to potentially rebound. But honestly, I don't think I will be buying either of these two companies just because they don't really fit into my overall strategy. Before we sign out for the video, I do want to touch on the upcoming earnings this week. So on Wednesday, July 23rd, we have two major announcements. Google is going to be announcing their earnings, and Tesla is also going to be announcing their earnings after the market closes. Tesla always experiences a ton of volatility around their earnings reports. Over the last 5 years, though, the stock is up almost 250%. However, keep in mind that that is pretty close to the lows back in 2020. So a lot of companies over the last 5 years are up a decent amount because of the large drop that was experienced in the first half of 2020. However, if you go out to January of 2021 till now, the stock has hardly made any gains, only up around 12%. However, I'm sure we will see a lot of movement around this upcoming earnings on Wednesday of this week. And what's really crazy for Tesla is a lot of investors don't really care what the company puts up in terms of their EPS. Right now, analysts are expecting around 44 cents of EPS for this quarter. That's down slightly from a year ago when they put up 52 cents of EPS. What investors and analysts are going to be paying attention to is what Elon talks about. Is he going to talk about his newly formed political party? That could be very bad for Tesla stock. If he's putting a lot of focus into that, a lot of investors are going to think negatively and probably sell off the stock. However, if they primarily focus on robo-taxis as well as robotics, that could be a big catalyst in the upward direction for the stock, especially in the short term. But the company that I am going to be paying closer attention to is Alphabet or Google. Over the last year, Google is only up less than 2%, which is absolutely insane. However, from the bottom back in April, the stock is up closer to 30%, which is some decent gains, but it's still crazy to think about a company like Google trading at a PE ratio of around a 20, while the rest of the Magnificent Seven are closer to a 30 PE ratio. Over the last 5 years, however, Google has outperformed the market. It's put up a return of around 145%. And even though the stock is up around 30% in just the last few months, in my opinion, it is still undervalued. The forward P ratio is sitting at a 19.38. They have a PEG ratio of a 1.4. If you compare these metrics across a lot of other big tech companies, they are undervalued. Google is an undervalued company. I don't know how many times I have to say that, but if I had to pick one Meg 7 stock to put all of my portfolio into, it would be Google. I have the most faith in Google outperforming the market over the next 5 years compared to any of the rest Magnificent Seven stocks. Not only does Google have very low valuation risk, they also continue to grow their EPS numbers year over year. A year ago, they put up $8.04 of EPS. They're expected to put up $9.60 of EPS in 2025, and then $10.19 of EPS in 2026. If you take this $10.19 and you just assume that Google should be trading at a 25 PE ratio, basically in line with the broader market, that would mean that the stock should be trading closer to $250 per share. Right now, analysts are only expecting Google to put up $2.17 of EPS in this upcoming announcement. However, in my opinion, I think Google is going to put up somewhere between $2.40 to $2.50 of EPS. If we look just last quarter, they put up $2.81 of EPS. That beat analyst expectations by 40%. I don't think that analysts have increased their expectations for this current quarter to actually come in line with how the business is going to perform. So we will see, I think, Google come through with a very solid beat, and I think the stock will move up probably a little bit after earnings. I don't think it's going to move up substantially just because the valuation for this company really hasn't been reflected in line with the rest of the market. But do keep in mind that out of all of the companies that we discussed in this video, the only one that I own is Google. So I am clearly very bullish and biased in the favor of Google and them outperforming over the years to come. They are the largest position in all of my portfolios. Here in the YouTube portfolio, it is my largest position by far. Right now, I have 77 shares of Google with a market value of $14,000, and we are up almost 20% on this position. But of course, let me know your opinions down in the comment section, especially on Nebius as well as DLO. I'm interested on what you guys think. Out of the two companies, if you had to buy one, would you buy Nebius or would you buy DLO? Or do you already hold both of these positions in your portfolio? Let me know down below. If you did enjoy the video, drop a like while you're down there and subscribe for more videos like this one. And as always, have a wonderful rest of your day.